Hey everybody, back to the Economist here. Today we are going to review and analyze the Inflation Reduction Act. If you watched my video from last week, I talked about this upcoming legislation. It was actually signed roughly about 2 weeks ago. So we're going to get into it here, and I'm going to show you what some of the messages from the government and media have been saying, and what the most likely economic impact will be from this piece of legislation. Okay, so there's going to be a few different formulas I want y'all to keep in mind here. This is our GDP formula. So this is a formula that basically describes the components of how we calculate the growth of our domestic product, or in other words, how much our country is producing as a whole. And that's a good indicator of how well we are doing as a country, how well our economy is doing. So GDP equals the adding of consumption, which is the average consumer spending on the open market, investment, which can be investment in stocks, companies, capital, infrastructure, government expenditures, which is a government purchase of anything on the open market. And then you've got the import-export deficit, which I've spoken about many times. But effectively, you're only going to be adding this if your country is exporting more than they are importing, so producing more than they are buying. Otherwise, this will end up being a subtraction or an addition of a negative number. Second, keep in mind the relationship between the price level and the supply of money, right? So this is a direct relationship. As the supply of money increases, you see from demand line 1 to demand line 2, the price increases with it. This is only occurring because the supply is increasing without there actually being a real increase in output for our country, right? So we have been increasing our money supply while our GDP, our domestic product, has, in the past year, it's been decreasing. It has not been growing at any rate that would basically constitute such an increase in the money supply. So these are the two things I want you to keep in mind here, right? The obvious relationship between increasing the prices of things, or the obvious relationship between increasing the money supply and the increasing of prices, i.e. inflation, and the relationship that our gross domestic product has on our economy as a whole. All right, so here is the actual schedule of what this bill is planning to spend or cost the government, and what the bill is expected to bring in over a little over or a little under the next decade. So 2022 to 2031, these are projections on how this bill will affect our country as a whole, fiscally at least. And you can see first off that they are looking at expanding the tax credit eligibilities for clean and green energy. So lots of tax credits available here for people to be able to enjoy a cut in their tax burden if they were to go ahead and invest. And one of the many ways that they have having you be eligible to receive this tax credit if you were to invest. So clean energy would be, obviously it's a big spectrum. It includes purchasing electric vehicles, solar equipment. It includes investing into green companies, investing into wind turbine energy. There's all kinds of classifications of what green energy is or clean energy is. And then in general, they have a section here that just promotes the general spending of money on climate or other clean energy producing initiatives. So this is a pretty big change from the current tax credit system where most of the clean energy credits are geared towards corporations. Now they're kind of opening up towards the common consumer here. However, the problem here is that the common consumer often can't afford the startup cost. They can't afford the cost of an electric vehicle or the cost of installing solar panels. And this is going to be a big roadblock here for most people to actually be able to enjoy such credits. So the idea is that these credits will make that cost cheaper, especially in the long run. Remains to be seen, but I think that's the plan for offering all these credits. Then you've got healthcare. So this is a big part of it. They are expanding a lot of the ACA subsidies, the Affordable Care Act subsidies. This was set to expire, I believe, by 2025. So they are expanding a lot of these, which is said to save consumers a lot of money in healthcare, and a lot of money by the Part D, the prescription drug plan redesign. So between the healthcare subsidy and prescription drug redesign, savings are going to, savings will be in the next section. The actual total spent on that will be $98 billion. So the total spent on energy and climate to offer these credits, which means the government is not taking in this money, right? They are affording you the opportunity to deduct your tax burden by this amount. They are expecting to lose $386 billion in that sector in the next decade, and lose about $98 billion spending this type of money on these subsidies and the Part D program. The savings and the revenue, right? So this is what the majority of the bill totes. This is what they're really kind of championing here. This is the part of the bill that has been mostly in the media. And they are basically saying that these savings here is going to make up for any spending. And it's funny because although the idea here is that savings will make up for spending, I will show you a little later how that's really not necessarily true, considering who is doing the spending and who is doing the saving. So in any case, just going by their numbers here, the health savings that the American economy will enjoy is $322 billion. And the revenue from the 15% corporate minimum tax and total redesign of the IRS compliance department, an $80 billion investment into IRS, which should equate to about an additional $124 billion in revenue, adding on to the corporate minimum and some other fees that they're adding in, which have to do somewhat with clean energy, is going to equal $468 billion. So what they're doing here is then taking the $468 billion that they expect or are scheduling to take in revenue and savings, and they are adding that to the $322 billion that they're expecting to take in savings, and they are coming to a total savings and revenue amount of $790 billion. They are then taking the healthcare expenditures and the Green Initiative tax credit expenditures, adding those together to get $485 billion. They are subtracting the savings and revenue, or they are subtracting the spending and tax breaks from the savings and revenue to get a total net deficit reduction of $305 billion. So here are issues that I have with what the bill is stated to accomplish and what is kind of being promoted as to the purpose of the bill versus what I actually see in these numbers. One, if you notice the expenditures, so $98 billion known, right? In the next decade, we know for a fact there will be $98 billion expended by the government to continue the ACA subsidies and to continue the Part D prescription drug plan redesign and to end the Trump-era rebates and all kinds of other ways they are altering health plans and how consumers access drug prices and health prices in an effort to help save money for the consumer. And that's a great thing, right? Here's the problem, though. That money's saved. I'm assuming they are expecting that saved money to then just go ahead and be pocketed and saved by the average consumer. Because typically when the government goes and makes it so that the supply of money on the market, right? Remember that old graph that I showed in the beginning of the video that showed that as the supply of money increased, so did the prices, the inflation increase with it, right? It's a positive relationship. So what the government is doing by allowing you to have $386 billion in tax credits and giving a known government expenditure of $98 billion is they are guaranteeing that several billions of those dollars will be in consumers' pockets or will be directly spent already by the government itself. So we know that then the GDP formula that we looked at is going to increase by a little bit. We don't know how much. We don't know how much of the $98 billion that they plan to spend will reflect in GDP growth. But when the government spends, as we saw in the formula, GDP tends to go up. When consumers spend, again, we don't know how much of the 386 in tax credits and saved money that they're going to actually spend, but some portion of the consumer savings we can expect to be spent, right? So again, both actions adding to the money supply. Those aren't the only planned savings, right? They're also planning on saving consumers $322 billion overall in health savings because of many of these redesigns. So not only are we spending, the government's spending $98 billion to make this happen, but they're hoping that consumers will save $322 billion. Again, we cannot expect, at least it would seem as though the way the government has calculated this, that they are expecting this. But I think a person of average intelligence can understand that most consumers, when they save money, tend to find a way to spend at least some portion of that saved money, right? And in many cases, that's almost the point of why the Fed or the government chooses to increase the money supply, because they want it to be spent. Typically, that's when we're in a stage where we either want to spur economic activity or try to get to a more desired level of inflation, which, yes, there is a desired level of inflation. See my other videos in the past about that. But so the actions that we would normally take, the Fed would normally take, or the government would normally take to increase inflation, they're actually taking in this bill. They're spending money themselves, and they're making it so that average consumers have more money in their pocket, right? So that kind of lends toward the opposite of what the name of the bill is, which is the Inflation Reduction Act. Now, the reason why they're calling it the Inflation Reduction Act is because they believe that the $322 billion that you have, or they have planned to save you, they believe that the $322 billion was money that was going to be spent. That was money that was going to be spent on healthcare, and that by them redesigning and expanding these subsidies, they are saving that money from being spent, and therefore saving $322 billion from being put out into the supply. And so I guess a small part of me can understand that logic, but it's just not realistic, right? We both know, and we all know, that when you expand consumers' access and supply of money, when you expand the money, the disposable income of your consumers, you are expecting, and in many cases, you are desiring them to go ahead and spend that. So it doesn't make sense to then say, well, now we expect that they won't spend it because we need to get inflation under control, and this will them not spending that money because they were going to spend it. Now they won't spend it, and that's money that we're saving from going on the open market and into our supply, right? It just doesn't make sense. So that's my first problem. Second problem is the idea that this is going to close the deficit by $305 billion. I'm just not sure how they're getting that number. I understand that $790 billion minus, and that's the revenue plus the health savings, minus $305 $485 billion, which is the expected health expenditure and the expected tax credit losses, leaves a total of $305 billion that they are saying will go ahead and reduce the government's deficit. But what I'm not understanding is how they're calculating the health savings that they expect consumers to save in the government savings, as if it was the government themselves that was going to spend the money that they are then saving themselves from spending by spending that money in the $98 billion of expenditures to expand these subsidies. So I know it's a little confusing. It's confusing to me too, because it just doesn't make sense, right? So let's basically break it down a little further here. The government is saying that the $322 billion in health savings that they are calculating that consumers will save based on the $98 billion in investment in expanding subsidies and redesigning Part D prescription drug plans and the Medicare plan, that money that they're spending to save that $322 billion for you and me, the average consumer, can be calculated into the government's total spending as a saving for the government, to then be added to the revenue that is expected to come in from the tax compliance redesign and from the new 15% corporate minimum, which is in fact the actual real stream of revenue, right? So the two together does equal $790 billion. The problem is the only actual form of government revenue here is the tax portion. That's it. So that $468 billion in tax revenue that they expect to receive from these altered tax codes and reinforced compliance, that money is actually going to be revenue, right? And the other portion, the health savings, there's no part of that can be expected to be kept by the government. The whole purpose is for the average consumer to be saved that money. And so therefore you cannot calculate that into the reduction of deficit, because it was never the government's to begin with, right? The end is you saving that money, right? So if we backed out the $322 billion in health savings, we no longer have a $790 billion expected total revenue for the government over the next decade, right? We have a much lower expected revenue. Now it's 468 known source of revenue compared to 485 known source of expenditure and loss, and we can see that that's clearly a net loss of $17 billion, right? So the idea that a net loss of $17 billion is going to equal any sort of deficit reduction is false. We all know that that's clearly a deficit increase. Money now that we have lost. More money we spent than what we took in, right? The definition of a deficit. Now, add to that $17 billion, that new calculation of $17 billion, that real calculation of $17 billion, and we include a $40 billion Ukraine aid package that was just authorized last week. And we tally onto that what's expected to be, judged by the University of Pennsylvania Wharton Business School, to be about a $325 billion expense for the latest student loan forgiveness plan that was just announced. And we're talking upwards of about $390 billion that they just went ahead and spent. So let's say we didn't just calculate a more realistic $17 billion deficit. Let's say the $305 billion deficit, like they calculate, reduction is more likely. Well, they just spent $390 in the next couple weeks following that anyways, right? So we're back in a deficit regardless on how you calculate it. And this is classic government spending, right? So even though last week when I did a video on the good-looking GDP numbers and the way the import-export deficit had closed and the way the GDP and the inflation numbers had kind of started increasing at a smaller rate, and I praised the administration Within a week or two, they went ahead and reversed all of those praises, and they, you know, I don't want to say are lying about it, but it's it's certainly not an Inflation Reduction Act, right? We just calculated about how the increase in money supply is going to actually increase our inflation rates, and there is more spending here than there is actual saving, right? And even if, again, it was all just savings, as if savings does not get spent, we all know that that's not the case. Savings do get spent, right? So none of the bill and how it was proposed and how it has been marketed is really accurate, but I wanted to show you the numbers on it. I wanted to show you why I felt like that. I mean, this is all opinion at the end of the day, but this is opinion based on analysis, and if anybody has any kind of different analysis, I'd love to hear it. I'd love for you to comment, email, what have you. I mean, this is all economics is an art form, and so there are many interpretations. But yeah, so that's the latest round of what I've got from the government here, and how I think it's going to affect our economy. There's going to be more to come, because I do want to explain how the tax difference in tax revenue, right, and why they felt the need to kind of redo the tax program. I want to talk about the way in which companies have been getting out from paying the accurate amount of taxes. I'm sure we've all heard the 55 companies in America spiel and how they haven't paid taxes in the past year, and it's not totally false. I want to talk about that. I want to talk about how they've been able to get away with that, and why a revision of the tax code probably was necessary. I don't know if this was the best revision I could have thought of, but that's something for another video at another time. I appreciate y'all's time today, and talk to you soon.